Well, let's see. Good morning. What time is it? I don't even know. Let's take a look. Yeah, what the hell do you care, right? Anyway, it's 12:30 on Tuesday afternoon, and this is Dave coming to you from the paddock here in Southern Maryland, and this is episode 9 of our investment series. This is stock options. I forgot to do this yesterday. So the where are you map, right? We've come all the way through these now, and this is where we are today. Options, all right? Yeah, options market is what I have it listed as. So we have popped now into the extreme risk zone. If you do any options play because of what you see in this video, you're a moron. You're an idiot. Don't do it. Am I being unclear here in any way? This video is the beginning of your journey. This is dangerous shit to get into if you're a novice investor, okay? Don't do it. This is the beginning of your training, the beginning of your education, the beginning of your enlightenment process. It is not your enlightenment. It is not. Okay, the extreme risk zone. Why is it extreme? So it has all the risks of all the other categories. You know, once you buy an options contract, you lose control of it. You are now into the market driven valuation process like you are with stocks and crypto, gold and silver, ETFs. So you carry all that risk. But it also carries that high risk element that you could choose poorly. You could make a bad call on which stock you're going to do an options play on. You could get your direction wrong. The example I'm going to show you is you assume you want to buy some Amazon. You want to do an Amazon options play, and you believe Amazon's going to get more valuable. You also then have to decide in what time period do you think it's going to get more valuable. And that's why we are now in the extreme zone. Time is no longer your friend. As soon as you put money and apply money and purchase an options contract, option contracts expire on a certain date. And so that clock starts ticking the second you buy it or sell it. So there's now a time factor. So all the other factors play in, and there's a time factor. And the option contract you purchase could expire worthless. You could lose all of your money that you put into this option, this alternative. And that's why we're in the extreme zone. Because if you get any of it wrong, there's a good chance you're going to lose all your money in this area. That's why you only put a tiny percentage of your, I don't care how good you are, you only put a tiny percentage of your net worth, your family's future into this stripe. So for today, guys, I got out my my second Dracula pipe. You've seen this one. And now I'm getting out this little guy. I have to say I don't like the bowl being this close to my face or this close to my nose, but I love how this pipe looks. I love the Dracula look. So this is a Peterson ADS Dracula, obviously. And I'm still smoking that Black Irish Twist. I didn't smoke too much like yesterday, and I have not smoked too much this morning. I just been busy. And I've been busy doing keychains. Hey, now that I shipped 13 keychains out this morning. And anyway, that's just getting all that done. The boxes built, everything in the boxes labeled to the post office. Anyway, that's what I've been doing. So I haven't had much time. So I'm on my first bowl. It's almost done. Peterson ADS Dracula Black Irish Twist. It does taste good. Thank you, Greg. All right, guys, options is the first time we've talked about an investment that executes or takes advantage of what we call leverage. You're not actually buying an asset, you're leveraging an asset. And we'll talk about that as we get onto it. I've got real examples here. We'll go to the screens. You buy options in what are called contracts. So as you would buy a stock, you would buy it with a share. You buy a share of stock. You buy a contract of options. So we will be talking about contracts. One contract leverages 100 shares, okay? Leverage, contracts, 100. I think this bowl is done. So when you go to the screens, you're going to see the price of a contract, but you have to take that price and multiply by 100 because you're actually applying it to 100. So contracts are priced, but you got to think it's 100 times that price. So if you see $5.95 for a contract, you're actually going to pay $595 for that contract. Again, you're going to see that on the screen. See, the other concept of contracts and options that you really have to understand is if you're buying an options contract that is equivalent to the stock price today, you are buying it at what is called at the money, or ATM. So if you purchase the contract that is at the current value of the stock, you are buying it at the money, or ATM. If you are buying an options contract to leverage the stock at a price lower than the current value, you're buying it in the money, or ITM. And if you're buying a contract that at a strike price, there's another lingo for you. If you're buying a contract that is valued at a value that is higher than the current stock price, you are buying it out of the money. Lots of times options contracts are valued in like $5 increments. So you can move what's called the strike price. So the price of the stock you think it's headed to is the strike price. And a lot of people buy out of the money, so higher than, and you think it's going to crawl up to your value. So you're buying $5 or $10 over the stock price. So you're picking a strike price that is $10 over. You're picking a strike price that is $10 out of the money. It's just lingo. You just got to learn it. So at the money, out of the money, in the money. The other thing you have to decide is usually options are done in monthly contracts. There's also weeklies. I don't want to get into those. Typically, we buy options that expire on the third Thursday of any given month. So if you buy March contracts, they'll expire on the third Thursday. So you have what's called time decay from the minute you purchase it until you get rid of it. It's decaying, the time decay. So you just want to be careful of that. That's why this is so dangerous, because the clock's running whether your guesses or your analysis were correct or not. That time decay marches on like a metronome, no matter what's happening to the value of your investment. So let me repeat this. If you do any options trading based on this video, you're an idiot. You're a moron. I'm not providing you enough material to be smart enough to go do an options play. You really got to go study this. This is really why I didn't want to do these series, because this is a sexy one. When I get done with you, you're going to want to do it. And you probably just end up losing all your money that you put into it. So options are what we would call in the military world a force multiplier. An aircraft carrier is a force multiplier. One ship can project 300 aircraft, so it's a force multiplier. Option contracts, you buy one contract and you then benefit. We'll use benefit. You benefit from actually controlling interest in 100 shares. So 1 projects 100, so it's a force multiplier. The other thing you'll hear people say is it greatly amplifies the movement of the underlying asset. And so we're going to continue to use Amazon. I'm not saying it's the one to use, but everybody knows the company. Everybody talks about the stock. So we're just going to stay on Amazon for this episode. So if you buy an options contract for Amazon and Amazon goes up $10 in stock value, you stand to make a lot more than that $10 on the stock. It exacerbates the movement of the stock. That is equally true if you bet on the stock going up and it goes down, you get hurt exponentially. The movements of the underlying asset are greatly amplified by options contracts. If your analysis is right and you are good at this, a dollar stock move can turn into 10 times that in the options world. It's equally true to hurt you very badly as well. We have to delingo a few things. If you think Amazon is going to go up, one of the strategies you could take on is I will buy calls. I will buy call options is the lingo. All right? Calls. It's just a word. You just have to understand that calls means, that you're buying an option. You're buying the options to eventually purchase all those stock if you wanted to. But most people who play options don't buy options to have them exercised. Most people buy them to make money on the value of the option itself. So if you think the underlying asset, Amazon in this case, is going to go higher, you would want to buy calls. You would want to buy call options. If you think the value of the Amazon stock is going down, one strategy is you'd want to buy puts. All right, calls and puts. Buy and sell, calls and puts. Calls if you think it's going up, puts if you think it's going down. There are 100 option strategies, okay? Man, you could spend months just learning lingo and strategies and how to trade. It takes option traders sometimes years to get good at it. I'm going to discuss 2 option strategies. If you think the underlying asset, Amazon, is going up, you will buy call options. If you think the value of the Amazon stock is going down, you'll buy put options, because put options actually increase in value as the stock goes down in price. And so you'll hear a really seasoned investor saying, I care not which way the market moves. I just care that the market moves. Because you can make money when things go up by buying the asset or by buying call options. But you can make just as much money and sometimes more when asset values go down because you're buying put options. So that's why true investors don't weep and cry and gnash their teeth about, oh, the market's gone down. They're probably making money on shorts or there's another lingo, on puts. They can short stock, which means they're betting against it. We'll talk about that tomorrow in the futures market because I short futures. That's for tomorrow. Okay? But you can make money on assets you think are going up, and you can make money on assets you think are going down. And that's one of the great reasons people choose to play in the options market. It's hard to play. It's hard to make money on gold when you own it and it goes down, right? To own real estate and have the market go down, it's hard to make money. Your ETFs, there are short ETFs, by the way, not for the scope of this series. All right. So most asset classes, it's harder to make money when that asset class goes down in value. The options market was made to be able to hedge market moves. So It's just as easy to make money when market values decline as it is to make money when market values increase. All right, you bastards, I can feel you already getting excited. Wait a minute, I can make money when things decline? Yeah, that's pretty cool, isn't it? Don't do it off of this video. But it's a great way. If your 401k value is headed down and you've done some training, you can make money in this market while it goes down, maybe to offset or hedge your other assets going down. So if you own a piece of real estate and the market value of that real estate is going down and it's hurting your portfolio, you can come into the options or futures market and make money, put positive cash flow to your portfolio on declining assets. So therefore you're hedging your positively priced assets with an ability to hedge that, because it's going down. You can hedge it going down by making money when it goes down. Sounds sexy. Again, you can lose everything in this option stripe. It's easy to lose your whole account. Call it blowing it up. You blew yourself up. You blew your account up. People go away for a year while they rethink whether they want to even start this again. So be careful. So guys, options, calls, puts, strike price, time decay, ATM, ITM, OTM, calls, puts, buy, sell, multiplier, leverage, 1 to 100. You can already tell in the first 10 minutes of this video, this is different, right? In none of the other 8 videos have I started out with so much lingo. That should tell you something. There's a whole, the price of options are driven by the Greeks. And I don't mean Greece. Okay? You got alpha, beta, gamma, theta. These are all values that surround the stock and option pricing scenario. And it's called learning the Greeks. I'm not doing that. I'm telling you the Greeks, the 4 big Greeks, if you understand them, can help you better play the options market. I'm not touching them here. So we're going to go to the screens next. I'm going to show you a real world calculation based on today's values of why someone chooses to go into the option market. So let's swing over to the screens. I'm going to show you a real world example. All right, guys, so you're in a live trading session now. This is my trading platform. And you'll see that we have Amazon, AMZN, Amazon. So this is the Amazon stock. This is the daily price chart. And we can take it back almost 2 years. All right, so you look at this stock, you know Amazon, you know you've looked at its fundamentals, and you say to yourself, I think Amazon is going to go up and keep going up. So I want to do an options play on it though. So what do? So the current stock price is 174.28. So it was 175 a few minutes ago. So we don't need all this. All right, here's the last 2 or 3 months. You can see that here, and you can see it's clearly in an uptrend. It's come down a little bit, and you think, okay, I think Amazon's going to head back up. And it had a high of $180 yesterday. We can pick it up for 175 or 174 today. So how do we play options? Put that screen away. We'll bring the big screen down. Okay, so this is an options chain. See all these options by month. You could buy the March options and then see all these weeklies. I'm not even going to address these. These are your weekly options. Then you have April, May, June, July, August, and you can go all the way out to January of 26 or even June of 26. So you can buy them way out. Okay, And so my synopsis is, I think Amazon will go from 175 to 185 in about 3 months. So 3 months out is June. So I'm going to come in here and I want to look at the June options chain. And here you can see 14 different strike prices. The strike price is here. This column is strike price. You can see we're pretty much 175 is where the color changes. 175 is at the money. And as we move up, this is the call side of the screen. This is the put side of the screen. We're going to talk about, because we think Amazon's going to go up over the next few months, we're going to buy calls. And so here's today's price. The at the money is 175 for June options. So we are talking about June call options with a strike price at the money of 175. You see how the lingo and the language is just so much more intense? If I wanted to buy at the money call options, it would cost me $12.25 per share, but you bought to buy the 100, right? So it's this price, $12.25. You would have to spend $1,225 for an options contract. But I don't want to do that. I'm going to go down and say, hang on, let me see my example real quick. Yeah, I did the 185 example. So I think it's going to go up to $185 in the next 3 months. All right. So currently, if you wanted to buy the June 185 strike call options, they are $7.90. So if you wanted to buy the at the money option, it's $12.25. But I want to buy the 185s because I think it's going to go up $10. So I want to buy out of the money $7.90. You can see there's a price difference right here, $12.25 to $7.90, and that plays into my calculations in a minute. Okay, so there's our example. So it's Amazon. It's currently valued at 175. We think over the next 3 months it's going to go to 185. I want to buy call. I want to give it some time, so I'm going to give it 3 months. So that's why I'm looking at June. And I want to buy at what I think the strike price will be by then. So I'm buying the 185 June strikes. And I'm going to pay $795 per contract. You might need to rewind that a few times because I'm going to put this away now. I'm going to show you what happens. All right, guys, here's the example. This is why people go into options. I'm going to assume you have $5,000 to invest. Amazon stock is at 175 today. I mean, it's currently 174.20, but it's $175. That means you can buy 28 shares of Amazon stock today. That means you're going to invest $4,900 of your $5,000. You're going to buy 28 shares at $1.75. And we're going to say the stock actually goes up to $185. It does what you thought it was going to do. If that's true, you put $5,180 back into your account, you end up making $280. All right? And that's how we say it. In fact, I shouldn't even do this right now. All right, so you put $5,180 back into your account. That's your 28 shares at $185 a share. So then how much did you make? Well, you put $5,180 into your account, but you spent $490 in the investment. That's back up here when you bought it. So you make 280 bucks. You made 5.7%. It's pretty good, right? Not a whole lot better than that CD we're talking about. You made $280 on your $4,900 investment. You made 5.7%. And there's no time factor here, right? This could be 1 hour, 1 day, 1 month, 1 year, right? There's no time here, right? But then people come here and say, here's the example pulled down from the screen, right? We're going to buy the July 2024 $185 calls at $9.25 per contract. We can buy 5 contracts. We invest $4,625. That's 5 contracts, $9.25, 100 times 100. We say you're right. Before these options expire on the 3rd Thursday of July, the stock goes to 185 at some point over the next day, week, month, 2 months. And so your July calls should move up to what the in the money value was when we bought them, which is $13.55. So the call you bought for $9.25 is now worth $13.55. And you sell them and you put $6,775 back into your account. That's the 5 contracts at $13.55 times 100. That means you made $6,775 off your $4,625. You actually made $2,100, $2,150. And so therefore, you made a 46% return. You made $2,150 on your $4,600. See how exciting that is? On the exact same amount of money, I mean, 49 here, 46.25 here. But using the value of leverage on options, instead of making $280, you made $2,100. Okay, this is very possible. And this is why people choose options. It's pretty sexy, isn't it? You can make money when things go up, and you can make money when it goes down, because you can reverse the scenario and say, I think Amazon is going to go down $10 and go to 165. So instead of buying calls at the 185 price, you buy puts at the 165 price. It works exactly the same, just the mirror image. That's pretty exciting and it's pretty cool, and you can lose all your money doing it. You can lose your ass on it. And I can feel the more aggressive you're like, hey, I'm going to move some money into an investment account and go start this options thing, you probably end up losing all your money. How can you lose money on this stuff? So let's talk about some real world examples. And we're going to continue to use Amazon. You saw that multi-year chart, man. It was low and slow, left, high and tight, right. So it had that perfect glide slope. I mean, it looks like a sure thing, right? We all know Amazon. It's doing great. It's a good stock. It's a good company. And you might think it's run by an evil sot, but I'm not, this is when I do these investment things, man, the cone of emotion comes down. There's no emotion. I don't really care about the character of the company, what its product is, who runs it. I mean, I shove all that aside. I'm not trying to teach ethical investing here. I'm trying to teach you about markets. So the Amazon is a strong company, doing well, performing well. Very few people have any issues with it fundamentally, financially. It's a good bet to take call options on. And then you try a call option and you put a date on it, okay? And the further out you move your date, let's say instead of buying the June calls, you bought September, it goes up, the prices go up. And if you buy a year out, they're quite a bit more money. So you just have to decide how much leverage do you want to put in, because the more the contract costs you, the fewer you can buy. So it's really up to you. But let's say you do the example we showed. You're betting in 90 days, Amazon will at some point go up in value. And if it doesn't get all the way to 185, but it goes up far enough for you to feel like you made enough money, you just sell your calls and you just get out. You don't have to wait for it to get to 185. But you do this. You enter the call. You buy it on, what's today? Today's Tuesday. And it's trundling along. It's trundling along. And Friday comes and you enter the week and it's up a little bit. Man, you're feeling good. And over the weekend, a freighter gets stuck in the Panama Canal. Or the water levels in the Panama Canal refreshment lake fall to the point where they can't refresh the Panama Canal, because the Panama Canal does not use seawater. I don't know if you know that. It's got a lake up above it, and all the water that moves the water up in the locks comes from the lake, not the sea. And that's a huge design flaw, but it's what it is. And I think the Panama Canal is still running at about 50% of capacity. But if somebody gets stuck in it or they can't use it anymore, the price of Amazon stock is probably going to drop. If Amazon does something stupid with Taiwan on Monday, Amazon's probably not going to be looking too good. If Trump gets back in office and he decides to start a trade war with China, Amazon stock is probably not going to look very good. So things that have no relationship with the stock or your evaluation of it can impact your trading values. And with options, it's dangerous because you stuck an end date on there. And whatever happens in the world, those world events that we read about at night can have real impact to your investment portfolio. And if you have a time value, it may not correct in time. And so something that looked absolutely perfect and was churning along days or for weeks, and you're getting out, you're 45 days into this 90-day window that we used on ours, and then something happens, and you got about 4 weeks for it to correct. That's why it's so dangerous. Plus, your analysis could be wrong. You could pick a stock that looks great, but its fundamentals are gone to shit, and no one knows it yet. That's just so possible. There's so many things that can go wrong. That's why I just want to put it, it's in the extreme zone, all right? It's just about the worst thing you can do. Great returns when you get it right, can lose it all when you get it wrong. So that's why you manage how much you put in your options strategy totally, and then you limit it even more by how much of that you put into each individual trade, so you don't blow your account up. If this particular options trade goes to zero, it doesn't blow up your options trading account, much less your larger family portfolio. Guys, I think I'm going to be done with this because I don't want to give too much information. If you think you now are going to go later today or tomorrow, go do your first options trade based on this, I want you to grab something really heavy and just smash yourself in the head until you pass out. You should not do anything in the options market except study it, probably for months once you've watched this video. Do not allow your overexuberance to make money in a down market. Don't get too exuberant in that you can hedge other assets that are headed down in value by doing this. Don't get too excited, over exuberant because of the leverage factor. Because you have to get it right more than once. That's the other thing that a lot of people don't understand is the saying that I was taught was a lot of investors eat like a bird and shit like an elephant. That means you take in tiny wins and you just have these monster losses, and that's due to emotion. But it's a well-known saying in the trading world, and you have to be careful, because if you make $2,000, you make $2,000, and then you lose $5,000, on your third one, you blew up your account. You don't want it. I don't know. I'm not sure I want to give you any more information. Just be careful. because you have to be consistently good in the options market. You can't be good half the time. You can't be good every third time, or you'll blow your account up. I'm going to stop there, guys. You now know the options market exists. You know the basic lingo that surrounds the basis of it. You've heard two options concepts or strategies. If you think it's going up, you buy calls. If you think it's going down, you buy puts. There are hundreds of strategies, callers, condors, butterflies. I mean, blah, 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 right? You don't even have a clue what I'm saying. These are equally valid trading strategies, and I'm not even going to begin to address. You can go to Investopedia, you can go to Forbes. There are entire sites on options. There are entire programs that you can get into a chat room and trade with people who are doing it. People make a lot of money doing this, and people lose their life savings doing this. You just have to decide which one you're going to be. All right, guys. Hopefully you're not hitting yourself with a big heavy object right now. That's it. I'm gonna glue all these pieces together and get this up, and we'll call the options one done for the day.